Professors FM.
I'm Bridget Stomberg.
And I'm Lisa DeSimone.
And this is Taxes for the Masses.
Today's episode is on tax research presented at the 2025 Hawaii Accounting Research Conference.
In January 2025, researchers from around the world descended on the island of Oahu. Some of us did it to escape the miserable winter weather in our hometowns. Others did it for a chance to visit paradise, but all of us did it to kick off the new year by enjoying some interesting and well-done early accounting research. In today's episode, we discuss two papers presented in the tax sessions of the Hawaii Accounting Research Conference, or HARC. Hello, Lisa.
Hello, B.
So first off,
Yes.
Happy New Year.
Happy New Year.
As our listeners may know, and some people actually have approached me about this, we took a break around the holidays.
Okay, it was one episode.
It was one episode. I ran into someone and they were like, oh, when are you going to start podcasting again? I was like, people,
settle down.
Calm down.
We get a break too.
So we did take a break for one episode. So that means this is the first time that is it potted, podcasted, casted, recorded, I guess is what I should be saying. Recorded.
Yes.
So this is the first time that we recorded in a while and the first time in 2025.
Mm-hmm.
So what have you been up to?
Not a whole hell of a lot, to be honest. And it has been wonderful.
You've been working.
Well, okay. So yes, that is because the day I submitted grades, like I got done teaching, immediately submitted grades and got on a boat where I refused to check email for the entire week. And then I got back to, I'm not exaggerating, like at least 6 papers on my desk waiting for me to go in and do a bunch of work. So yes, I worked over the break, just not podcasting and just not very hard, I would say.
Okay. Well, not working hard is still working. So very responsible of you.
And you, what have you been up to?
I've gone to the extremes. So I was in Chicago. It was like 10 degrees, very cold, very wintry. And then most recently I was in Hawaii where it was 80 degrees and lovely and delightful. And I want to go back.
Yeah. So I was asked if I wanted to present my paper in Hawaii. And for some reason I was generous and said, oh, you guys can present it if you want. And I am really regretting that decision.
Yeah, we're going to have to talk about that. You can be generous when the conference is somewhere not in Hawaii. When it's in Hawaii, come on.
Yeah.
Come on.
Yeah. Lesson learned.
Please, because it was great. And I missed you. It was very sad. A paper of yours was being presented and I was sitting in the room and you were not there and it was sad.
So how was the conference otherwise?
It was really good. It's a 3-day conference at the University of Hawaii in Manoa. It was lovely. And then also from a research perspective, it's quite a large conference. There are multiple sessions happening at the same time, variety of topics, really diverse set of topics and really excellent papers. So some of the highlights, I think I mentioned it was in Hawaii in January.
Yes. Mm-hmm.
They had a great reception on the first night. They have real hula dancers. You get some exposure to indigenous Hawaiian culture. You get a little bit of a history lesson. It's really quite nice and educational on that front as well. Mm-hmm. And I really like the way that they set it up. So it's at the university. There's different classrooms and all the tax papers are presented in the same classroom all day long. So you really get a chance to kind of sit with the same 25, 30 people all day long. And it gets to have this almost sort of like very collaborative, campy feel where very free-flowing discussion, lots of comments. So yeah, the plan for today, like we usually do with conferences, is we've chosen a couple of papers off of the program, tried to come up with 2 that had a related topic. And so the common theme of these 2 papers that we're going to talk about today is how taxpayers can use financial instruments, investments, to avoid individual level taxes. Are you up for it?
I am. Let's do this.
All right. All right, so the first paper we're going to talk about is by Michael Dombra, Andrew Glover, Charles Lee, and Phil Quinn. as the title of the paper implies, it's called ETFs and the Wash Sale Loophole. I would say it's about really quantifying the extent to which taxpayers use ETFs to take advantage of wash sales. So you're our wash sale expert. Do you want to hit the highlights again for our listeners on what wash sales are all about?
Sure. Yeah. Okay. So let's start with the wash sale rule, because that's coming from the Internal Revenue Code. And the idea is that we're trying to prevent you from being able to sell a security at a loss and recognize that loss without actually changing your investment portfolio, without changing your economic position. Yeah. So if you sell it, but then you're buying it right back within 30 days, and that's 30 days in either direction, either before or after your sale at a loss, then that loss is not going to be recognizable, meaning you can't use it to offset your gains and reduce your tax burden.
Totally. And so this was actually one of our super early episodes, and you had an example in there of how this works, and we'll just go through that real quick again. So you used the example in that episode of me investing in Blake Corporation.
Which we conveniently chose as the name of your child. Absolutely.
I've got to hold it for the long term. So in the example, I purchased it at $14 a share, but the price dipped down to $10. And like you said, it
particularly as a teen, as a toddler, so many times. Yeah.
So I would really like to be able to recognize that $4 loss, like you said, particularly if I have other capital gains sitting around that I'd like to reduce. Mm-hmm. But as we noted, I am in this for the long haul. I am sticking to my investment in Blake Company for at least 18 to 22 years.
Possibly more.
At least. So what I would really like to do is sell the stock at 10, recognize that $4 loss, but then repurchase it in the hopes that things are going to turn around.
Yep.
But like you said, if I do that, if I repurchase that share of stock within a 30-day window, either before or after, the IRS is going to say no dice because your economic situation didn't really change, right? And it's kind of a nice principle of tax law. We don't let people recognize losses. We don't force them to recognize gains unless there's been like a really significant change in their economic circumstances.
Right.
So in that episode that we did, you astutely pointed out that ETFs potentially offer a way to like circumvent or skirt this substantially identical requirement, because it turns out that there's not a lot of clear, definitive guidance from the IRS about what, quote, substantially identical means.
Yeah.
So with an individual stock, like we just said, my investment in Blake Corporation, it's going to be really easy to know if I've had a wash sale or not, because if I sell my share of that particular company and then buy it back within that 30-day window, I've clearly violated the rules.
Clearly, yes.
But with ETFs or exchange-traded funds, it's not always so clear whether selling one ETF at a loss and purchasing another similar ETF within that window is a violation.
Right.
It's really going to come down to a determination of whether those ETFs are, quote, substantially identical, and not always easy to figure that out. We had talked on our initial episode about how some brokerage houses conservatively are looking at like 70% asset overlap and correlation in returns. Mm-hmm. Others were saying you could have 99% asset overlap and very highly correlated returns and still not violate that substantially identical test.
Right.
The reason that I thought this paper was interesting is tax nerds like us can always talk about these tax maneuvers or these ways that individuals could do things to minimize their tax liability. But oftentimes there's transaction costs associated with it. You have to know that this is a possibility for you. You have to be aware of this tax planning strategy. And so this paper is coming in and basically saying, okay, on paper, in theory, this is possible, but to what extent are investors actually swapping very highly correlated, what they call, quote, nearly identical ETFs to circumvent the wash sale rules?
Oh, cool. Okay.
So they're going to tackle the research question in 3 ways. And spoiler alert, all of the evidence that they find pretty clearly indicates that this type of behavior is happening.
Which I totally believe. I teach it in my class, and a lot of robo-advisors do it for you.
Yes. So maybe not a ton of what we would say tension, like, is this really happening? But I think they did a nice job with producing consistent evidence, and then they did some quantification.
And I think that's super important, especially because I think where my head goes with this idea is how aggressive are people being, right? We said that overlap of assets owned or the correlations of returns could be anywhere from 70 to 99%. And I kind of wonder, like, can they tell us how many people out there are doing it at 99% versus 70%? That would be very interesting, because 99% is a lot more aggressive. It's a lot more at risk of being overturned as a wash sale. But we don't know what that threshold is, and it seems very subjective how the tax authority is enforcing it now.
That's a really great comment, and they at least didn't talk about it in the presentation, but I think that's a really good point, because by having some evidence on where in the distribution this behavior is happening, they might actually be able to inform the guidance that the IRS.
Exactly. Yeah.
That's really great. All right. So what do? First, they look at the trading volume of what they call incumbent ETFs. So these are ETFs that already exist, and they're looking to see what happens to the trading volume when a new highly correlated ETF is introduced. And when they're thinking about correlation, they're looking at returns.
Okay.
So their argument is that, ignoring any tax effects, if you introduce a substitute good into the market, then demand for that incumbent good should decrease. And that's kind of Econ 101.
Yep.
But if this new ETF acts as a complement to the incumbent, allowing more investors to circumvent the wash sale rules, then the demand for the incumbent ETF might actually increase. And that's exactly what they find.
Okay. And it increases because now if my incumbent ETF is selling at a loss, I could recognize that loss by selling it and swap into this very similar high correlation ETF. And I haven't really changed my position, but I can recognize that loss.
Exactly. And vice versa. So if you're an investor in the new ETF and it's not doing well, you can go to the incumbent, and vice versa.
Okay.
So for my very simple brain, it's peanut butter and jelly, not chunky peanut butter and creamy peanut butter, right? There's complements, not substitutes.
Right.
Although, let's be real, chunky peanut butter is not a substitute for creamy peanut butter, but that's
because it's inherently better, correct?
I'm sorry, what?
Yes, chunky all the way.
How do I not know this about you? This would have changed a lot about our relationship. No.
Okay, we have known each other for 15 years.
15 years.
And it's taken this long for it to come up, so you really think it would have changed anything?
I really do. Hard to tell. Anyway, you're wrong. Second, listeners, please email in and weigh in on this debate, because there is no way that the masses are with you on this one. I'm sorry.
I've never been one to go with the masses.
Jeez. I'm sorry, people. My world has just been rocked. You think you know somebody, and then
this podcast is now over thanks to my love of chunky peanut butter. I'm sorry, everyone, but this isn't going to work anymore.
All right, back to the paper. Second, they have this really cool granular trading data, and they use that to find evidence of same-day swaps of highly correlated ETFs. So we're not even waiting like a day or two to try to course correct here. We're really keeping a consistent economic position, and we're seeing swaps happening in the same day. And what I found super interesting is that they actually find that investors are incurring costs, non-tax costs, to swap ETFs that are about 99% correlated in terms of returns.
And these costs are like transaction costs?
Yeah.
So to buy and to sell? Okay.
Yep. Clearly going to be less than the tax savings, but
Right.
Yeah. And then third, they show that institutions with more tax-sensitive investors hold more highly correlated ETFs, and that they have a significantly larger portion of their assets under management in highly correlated funds.
Very cool.
Last thing that they do, like I said, is they try to quantify this. And I thought these numbers were just bananas, but I have a small brain. They find that there's been $417 billion of swapping between highly correlated ETFs since 2001, and $106 billion in 2022 alone. So about 25% of all the activity that they're finding in the last 20 years has happened in the last couple of years. So clearly this is maybe becoming a more popular and well-known tax avoidance strategy. Easy to understand paper. They did a really nice job explaining it, relied on a bunch of different tests and databases to sort of put together some corroborating evidence, and then provided some really nice magnitudes.
Again, with those magnitudes, I would be interested in knowing, okay, so that's how much swapping is happening. That's how many assets are being swapped out. Can they get at what the tax savings are, right? Like how much tax revenues are being left on the table by allowing this activity? And to tie that back to my earlier comment, how much of it is really aggressive versus probably totally legal?
Definitely food for thought. And I believe that the quantification of the tax savings was something that came up in the discussion or in the Q&A. And that
Great.
is something that your paper tries to do, correct?
Yes.
Okay.
Yes.
Well, let's learn about that one.
So my paper is all about tax avoidance using DeFi lending. And I'm going to have to define some terms because this is all talking about cryptocurrencies in decentralized lending markets, which I know nothing about.
Yeah, I'm just going to go ahead and take a nap now. You can wake me up. You could record this on your own because my contributions to this are going to be limited. But yes, please teach us something.
I mean, if you only ate chunky peanut butter, you might have more to add here.
Probably true.
All right, so let's start by defining crypto. It's a digital currency.
And it's pseudonymous.
A word you now know how to pronounce,
I
thanks
do.
to me. Yes. And not because I knew how to pronounce it, but because I forced her to pronounce it multiple times in prior episodes. Yes, it's a pseudonymous digital currency where transactions are recorded using a decentralized digital and public ledger so people can see the transactions. So a DeFi market or a decentralized financial market doesn't rely on a government or bank to manage the money to be lent out. There's no relationship that you have with the lender. These are just people who go on these platforms and lend money into a pool of funds, and they could borrow money from that pool of funds. So we're not even looking at credit scores for potential borrowers or trying to talk up the banker to give them, get them to give you a better loan.
Okay, I'm with you so far.
Good, because I barely understood half of that. The way these markets work, according to people who actually know about these things, most of them, to my understanding, require loans to be over collateralized. The whole idea is to be able to show that you're good for paying back the loan.
Yeah.
And we know that crypto can be, let's say, volatile in value. And so the concern is that, if you show them that you have assets to cover your loan, what happens if those assets plummet in price or the assets that you borrowed go way up in price and now you can't cover your loan anymore? So most platforms require you to be over collateralized. The one that we use in our study requires you to have a loan to value ratio of 0.6. So if you're wanting to borrow $60,000, you have to pledge assets towards the loan and show that you're capable of providing at least $100,000, right? Because 60 divided by 100, that's the loan to value.
Okay.
And that gets you to the 0.6.
Tracking.
All right. Here's where it gets kind of cool, I think. If the value of your pledged assets drop or the value of your borrowed assets rises such that your loan to value ratio starts to exceed that threshold, in our case, 0.6, then anyone can come in. The lender, someone else can come in and liquidate that loan. They can basically claim those assets that you pledged that you had to put up in order to borrow. They can pay off the lender the amount of the loan, and then they get to pocket the difference. Because remember, you had to put up a whole bunch of assets more so than the value of the loan.
Interesting.
And so they could come in and liquidate at a profit, at least on a pre-tax basis. Okay, so let's talk about taxes.
Please.
Currently, cryptocurrencies are treated as property, not as a security.
Right. Yes.
You're going to pay taxes on any gains. You can use losses to offset any gains. But because it's not a security, there are no wash sale rules like we just talked about. Okay. So there's already a paper that my co-author, Daniel Rabetti, has on the use of crypto for tax loss harvesting. But the focus here of this paper is that when you take somebody's pledged assets to liquidate that loan, it's treated as if you are selling the assets you loaned out for the pledged borrower's assets that you are seizing.
I hope I'm going to get an example at some point in time.
Yes, we will get there. Give me a moment.
Thank you.
Punchline here on tax treatment of these liquidations is that you're going to have a gain on the liquidation equal to the fair market value of the pledged borrower's assets you're seizing, less the basis in the assets that you lent.
Okay.
And that basis could be really small if you've lent out highly appreciated assets.
All right. Makes sense.
All right. So let's get to this example. Let's say you bought Bitcoin at $40,000 in January of 2024, which is about what its value was. And it has recently, in the last few weeks, topped $100,000 in value.
Oof, okay.
Yeah, so you've done well for yourself over the last year, ma'am. You want to monetize that $60,000 in appreciation. You got bills to pay.
Yep.
You'd love to be able to spend that money. But if you sold the Bitcoin, you would have $60,000 gain to report on your tax return. And if you don't hold it for at least 1 year, I mean, we're getting close to a year here, but let's say, you're getting antsy. You don't want to hold it for at least 1 year. So you'd be taxed at the top short-term capital gains tax rates of 37%, possibly in addition to a net investment income tax of 3.8% if you make more than $200,000 as a single household or $250,000 married filing jointly.
Darn that investment income tax.
Right? If you can wait until the end of January of 2025 to sell, then those rates drop to the long-term capital gains rates of 20% plus that 3.8%.
Yep.
But still, you're on the hook for at least $14,000, give or take, on that $60,000 gain.
Okay. I'm with you.
So let's say, okay, you don't want to sell it. You'd rather use the Bitcoin to directly pay your bills and buy things, which is a possibility.
Sure.
So you're going to pay your $100,000 of Bitcoin value for $100,000 of goods or services. The problem is the tax treatment of that is also, it's as if you're selling your Bitcoin for those goods being received.
Yep.
Meaning the value that you're receiving is 100,000. You have to start subtract off the basis of what you're giving up, which is the 40,000, and you're still going to have a gain of 60,000.
Yep, exactly. Okay, I'm with you.
So both of those strategies aren't helping you monetize this $60,000 of appreciation in a tax efficient way. So what can you do? You can pledge your Bitcoin into a DeFi lending platform and then borrow against it.
Okay.
And this is kind of similar to the buy, borrow, die strategy that we've talked about before, where, ProPublica had that big article, talked about Elon Musk and some other wealthy people, that they have a lot of highly appreciated assets, in their case, usually stock in the companies that they founded or that they're managing. But they don't want to sell that stock because it's highly appreciated. Exactly. And so they'd have a bunch of taxes due. So instead, they borrow against those assets to fund their lifestyle. And they can do this on repeat until they die. And then those capital gains even disappear because we have a step up in basis upon death to fair market value.
Yeah. Okay.
All right. So this is a similar idea, but using crypto markets, basically. So let's say you borrow stable coins from me. And stable coins are supposed to be pretty stable in value, hence the name. And your basis in those stable coins is fair market value of those coins at the time that you borrow them.
Okay.
So you can use those stable coins to buy things you want to buy. And on those trades, you can pay the $100,000 of stable coins for $100,000 of Rari joggers if you want to. Mm-hmm. And because your basis in the stable coins is the fair market value,
no tax.
There's no taxable event there.
Okay.
All right. So you're going to pledge your Bitcoin of $100,000 and get back $60,000 in stable coins. But let's say now that your Bitcoin tanks in value. It goes down from $100,000 to $80,000.
Okay.
And you had borrowed $60,000 worth of stable coins, but your pledged assets are now only worth $80,000. So your loan to value ratio has now gone up to 0.75, meaning it's not in good standing according to the rules of the platform. So me as your lender, as an example, I can come along and liquidate that loan. I can seize your $80,000 worth of pledged assets of Bitcoin.
Yep.
Pay off my $60,000 of loan that I had lent you, and I can pocket the $20,000 difference.
Okay, that sounds good.
Right? Seems like a win.
Okay, what's the problem?
The problem is that liquidating the loan is treated like a taxable event to me. I have a taxable gain equal to the fair market value of your pledged assets, $80,000, which is what they're worth now,
yep,
less my basis in the assets that I lent you. But what if my stable coins that I lent you haven't always been so stable? And that's something that's actually happened in real life. So let's say my stable coins have appreciated a lot in value since the time that I acquired them, such that my basis in them is only $10,000. Now my taxable gain on liquidating your loan is the proceeds I receive, $80,000, less my basis in the assets that I'm giving up, $10,000. So I have a $70,000 gain on liquidating your loan. And if I've only owned those stable coins for less than a year, then that's about $26,000 in taxes that I owe at short-term capital gains tax rates.
Which is bigger than the $20,000 windfall you're going to get from liquidating the loan.
Exactly. So it's no longer profitable for me to liquidate that loan.
Got it.
So the punchline here is that there could be a bunch of unliquidated loans in these DeFi lending markets that the only reason that they're unliquidated is because people want to avoid taxes on the liquidation.
Okay.
And having a whole bunch of loans that are not in good standing that remain unliquidated basically brings a lot of risk into the DeFi lending market.
There's a lot going on here.
There's a lot. I will never, ever talk about crypto or DeFi lending markets ever again because my head is about to explode.
Well, thank you for doing it for us.
You're very welcome.
All right, time for the good, the bad, and the ugly. And for the good, obviously, it was a great conference, wonderful location, also very cool papers. There were so many different topics that people covered. I mean, it was individual taxes, it was taxes in the labor market, it was these two papers that we talked about today. There was auditing and tax. It was a wide variety of really cool and interesting papers.
Nice. Yeah, it sounds like a super interesting conference, and again, one that that I need to not say no to in the future.
No. Definitely, I think some interesting takeaways. I think the wash sale paper is highlighting a consequence of ambiguity in the tax law, right? If there was if there was more guidance about what constitutes a wash sale, maybe we wouldn't see. Well, unclear. We might not see this much activity, or we might see ETFs intentionally, setting themselves up to not have the overlap and to keep that, keep themselves open as an option for investors who are looking to circumvent the wash sale rule. The most interesting question about this paper, I think, is someone asked, why doesn't the IRS set a bright line rule? And my cynical response was, they don't really have the time or the money or resources. But then someone else gave what I thought was an even more cynical response, which was, if you establish a bright line rule, then you're going to shut down lots of opportunities for this behavior. And I believe someone at the conference said that you can actually see the former IRS commissioners engaging in this swapping behavior.
Wow.
And so, someone out-cynicked me and basically said maybe they know that if they do this, they're going to hurt themselves. They're going to hurt some of their politician friends and other investors who are actively engaging in this type of tax avoidance behavior. So I thought that was particularly interesting.
That is super interesting.
The bad, obviously, was that you weren't there.
Yeah.
And
bad for both of us, I will say.
And being in Hawaii makes it really hard to come back to 10 inches of snow.
Ah, wow. Do you really have 10 inches?
It's depending on where you put your ruler, it's somewhere between 8 and 10 inches.
Yowzer. Yeah. I'm going to go ahead and say that's ugly. That's gross.
I'm not going to argue with you about that.
Yeah. And I'm going to add one more ugly, which is that crypto makes my head hurt.
As it does mine. And all those examples of you, when you're saying you were going to buy Bitcoin, you were obviously talking about the royal you, because I am never going to buy Bitcoin or stablecoin or
neither am I.
Stable bit or whatever it is.
You know what I would buy though?
Chunky peanut butter.
Chunky peanut butter. Well, that's all we have time for today.
Be sure to join us for more tax nerdery on future episodes of Taxes for the Masses.